why don't we go ahead and jump into the presentation? And I think it's time to get started with the proverbial risk disclosure. So we don't need to read every word of this out loud, but do take a moment to read what's on your screen. And I think the key element here is that there is risk of loss in trading futures and options, or really with any investment. Past performance is no guarantee of future results, and that all funds committed should be purely risk capital. Stock market indexes versus individual stocks. Let's take a look at that. An index, it's intended to represent the entire stock market and then track changes over time. Just that simple. You know all these: the Dow Jones Industrial Average, the Nasdaq Composite, and the Standard & Poor's 500. Those are probably the biggest names. And what is the Dow Jones Industrial? 30 major companies in the US, Disney, Amex, Nike, Johnson & Johnson, to name a few. Started before 1900 with only 12 stocks. And then in the 1920s, it jumped to 30 stocks within the index, which is where it is now. And it's probably the biggest name in the world when it comes to stock indexes. And here's a graph of the Dow over the last 100 years. Okay, here's the Nasdaq Composite Index. 3,000 stocks listed on the Nasdaq exchange. It's the second largest exchange in the world after the NYSE. First electronic market founded in 1971. And here's what the Nasdaq has done during its lifetime. You see some of the volatility there, especially in the late 90s and early 2000s. And starting, looks like about 10 years ago, it's done nothing but move really straight up. Interesting. And of course, the S&P 500. It was the S&P 90 up until 1957. 500 stocks, representative of the economy. Coca-Cola, Kellogg, Chevron, Berkshire Hathaway. Many consider it the bellwether for the US economy and their best representation of the US market as a whole. And here's what the S&P has done since 1927. So looking at the stock market indexes versus individual stocks, some of the key things, sort of self-evident, but with liquidity, the major indexes are very liquid. They have a very narrow bid-ask spread. Individual stocks may not be as liquid if they are maybe mid-cap or small cap. Volatility, well, with an index, there's maybe 2,000 stocks within an index. So a move in a single stock won't really impact that index. But of course, with individual stocks, you've got event risk and company risk and all sorts of elements there that can dramatically impact the price of an individual stock. And then there's diversification. Obviously, an index is comprised of many stocks, so it takes a lot to move, all those stocks at once in the same direction. While of course, an individual stock may have risk that maybe headline risk about something happening with the company or a macro event that impacts that one stock. And on that same note, indexes are very convenient to just follow one or a few indexes rather than thousands of ETFs or stocks or mutual funds. And they are less volatile just by the way they're structured by definition. They might move 2 or 3% in a day, and that might be a pretty big move. Individual stocks, as you know, can move up to 20%, maybe 50% in a day, depending if it's a smaller cap stock. So on that note, let's see if we can look at an example of some volatile stocks. Here is Tesla versus the S&P 500. S&P 500 in blue looks a little bit like a flat line compared to the movement and the volatility in Tesla over the same period. See the dramatic trough and peak there in Tesla as it fluctuates quite wildly compared to the S&P. Check out Facebook. trading at 217.50, and then 5 days later, it's down 21%. But meanwhile, let's see what the Nasdaq was doing, which is where the Facebook trades. Nasdaq during that same period lost only 3.8%. So quite a dramatic difference there between the index and the individual component of that index. What about blue chip stocks, something that is not tech related? Well, let's look at Boeing. For 2019 through March 8, Boeing was up 31%. It's quite a big move. And meanwhile, the Dow gained over 9%, which is also a pretty big move in a short period of time. But then look what happened here. Just a few days later, Boeing was down 15%, and the Dow had lost only 0.45%. So there can still be some volatility even in non-tech related issues. Also, they can be non-correlated. An index may be up one day and individual stock may be down, or vice versa. They may move in different directions. For example, Under Armour was up 2.4% midday here, December 6th. At that same time, the Dow was down 1.6%. So I'm sure you've all experienced these types of movements if you've paid attention at all to the stock market and individual stocks and indexes.